Hello investors, welcome to one more monthly interaction with Canara Robeco. The month clearly has been again eventful in terms of geopolitics. So while we had thought that finally we have concluded the ceasefire and we might not return to the geopolitical escalation again immediately, we are again back to it within a month's period, and so is the oil price. For us, as we have consistently been saying, that the impact actually plays through the energy channel, and energy prices are again up from $70, $75 to roughly $90. So oil has been $70 in last 6 months to $110, $110 to $70, and again 85, $90. Clearly a lot of volatility. Having said this, on geopolitical front, clearly it seems to be getting protracted and getting escalated further with latest events whereby both while the conflict was largely limited to Hormuz Strait earlier, it is getting escalated on the other side of the strait, which is the Red Sea part, which is the exit channel for Saudi Arabia through the Iran proxy in Yemen, which is the Houthis. So clearly it is getting complicated. Having said that, we still continue to retain our base case that a lot of these events do happen, and particularly this event through energy channel has a larger impact on us if there is a knee-jerk price increase and it stays there. But if the price increase were to be gradual, for example, if the price remains at $85, $90 for 6 months and then it moves to $100 also, I think economy will absorb it. In all past instances, generally our experience has been the market reacts vehemently the first time the event happens, and as that event remains around for a longer period, even if it were to remain longer period, then market adjusts to it, the economy adjusts to it, and that's the phase in which we seem to be. Having said that, our base case still remains that it will not be as extended as the other war, which is Ukraine, Russia. And thus, at some point in time, in next few months, oil prices should retrace back. This is also driving most of the global economies to move towards renewables and electrification of vehicles, which will put further underlying demand supply pressure on the oil prices despite the supply choke. This is the one aspect which is very, very critical. There has been another aspect which has been playing out on the global front, which has been finally the investors have actually realized that the AI monetization is going to be a little more back-ended. The capexes are very, very high as compared to what kind of monetization is likely to happen. The chip prices and the infra prices have gone through the roof because of demand-supply mismatch, and it is playing into the capex numbers that are announced by hyperscalers in US. And in just last few months, the US hyperscalers have raised a debt of anywhere between 150 to 200 billion dollars for last 2 or 3 quarters. This is the first time they're actually funding the AI capex directly, indirectly through borrowings or equity raising, and clearly investors are not liking it, given that the monetization is still going to be a little more gradual and back-ended. And that's where you have seen quite a basically damage, quite a correction on the AI value chain, whether it is hyperscalers who have corrected to some degree, whether you have US basically hardware companies on semicon side or chip side, or the Korean market, which is down 30% in last 1.5, 2 months. So clearly, as we were saying in previous conversations also, the AI trade is getting unwounded. While there is no difference of opinion in terms of whether AI is transformational technology and whether it is going to be around or not, but clearly the trade which was going on and the exuberance and the way people were expecting that the monetization happen and the beneficiaries thereof in the value chain, they clearly have come under basically pressure lately. Why it is important for us? Because India was singled out as anti-AI play, except probably electrical equipment. So there is nothing to play in India, and the earnings growth was increasing in markets like Korea, Taiwan, and the FII flows, it was putting further pressure. Of course, we had our own challenges in terms of valuation earnings context, but this clearly global AI trade was putting pressure on the FII flows. We expect that to at least become neutral, if not positive, Our base case is that it will be positive this year in terms of FII flows, but at least it will become neutral if the global capital allocators can't actually see earnings in markets like Korea, Taiwan to the same degree, or upgrades to the same degree in US as they were seeing for last 1.5 years, and that makes Indian market at least relatively more compelling case to at least look at, which was completely ignored for some time. So those are the two aspects on global front. One has moved from positive to negative, which is geopolitics and energy prices, whereas the other, which is more AI-led capex and its implications for India from capital markets perspective, from FII flows perspective, that has clearly turned a little more constructive from where we were last month. Coming to domestic market, I think we have long argued this, that generally most of the stakeholders have been conservative. So despite energy prices going up, while the CAD can move up and the inflation will move up from where it is, fiscal deficit will move up from where it is, but largely the macro parameters will deteriorate from where they are if the oil prices were to remain at $100, 80 and 90, $100, but they are not bad. Most of the macroeconomic parameters still remain healthy. The underlying parameters remain healthy. The corporate balance sheets, real estate sector balance sheets, banking sector credit remains pristine. Probably in last 20 years, this is the second time you are seeing the lowest amount of NPAs in the banking system, incremental slippages in the banking system. So macro remains largely impeccable. Growth is a little bit of a challenge. The energy price and its translation into some of the macro parameters like current account deficit and currency is a challenge, which is of course getting addressed partly through the FCNR deposit scheme that is being run currently by banks. And we are hoping that anywhere between $50 to $80 billion of money will come through FCNR deposits. So that's the macro part remains little hostile on external front, but internally the core parameters right from fiscal, current account deficit, inflation to balance sheets across government, corporates, banks, real estate remains healthy. Of course, there was one more worry on domestic front, which was how the monsoon is likely to play out. Monsoon is still deficient. It is likely to be deficient because of El Nino, but how distribution plays out will be very, very critical in terms of how it impacts the incremental demand. As of now, it looks like June was really bad. It was a large deficit, but as you have moved into July, the overall deficit has come down to high double digit, which is I think 15 or 16% is the last number that I saw in terms of the all India rainfall deficit. Having said that, the distribution on the western part of the country seems to be fairly good. So Gujarat, Maharashtra, Karnataka, part of Madhya Pradesh, Rajasthan has received rains very well. So has been the eastern region. So, but it is too early to call out. The distribution is more important, as we highlighted, than the absolute deficit. The water reservoirs across the western parts of the country have largely come back to 80-90%, depending on which part of the western market you are talking about, western economic geography you are talking about. That brings me to the third aspect that we generally discuss, which is earnings. Our view largely has remained consistent, that despite all the worries and challenges, because fundamentally there were certain aspects which were put in place last year, which is the RBI's liquidity measure, whereby the OMOs happened to a tune of 10 to 12 lakh crore rupees, and thus the liquidity is in surplus. The credit growth has come back to more than 15%. Government has given a consumption boost of 4 to 5 lakh crore rupees annually last year. The government capex has normalized. The private capex continues to be in and around 10% YOY growth for BSE 500 companies. So when we look at all these parameters, and some of them were missing, and inflation has come back. When I look at these 5 or 6 parameters, it gives us fair bit of confidence that the earnings trajectory is going to be on the improving side, and which is what has been happening. Last third quarter financial year 26 was the first quarter where earnings started turning. Fourth quarter was even better. First quarter up till now, 50-60% of the companies have announced their results, and it clearly indicates that even this quarter you are going to have earnings growth, which is going to be in double digit. And in terms of expectation versus the delivery is faring far better. in most of the sectors. So when you look at sectorally, in banks, except one bank, banks and NBFCs, capital marketplace, entire financials has delivered good numbers. Industrials continues to deliver good number. Pharma continues to deliver good number. Cement has delivered better numbers than estimates. Consumer discretionary and even FMCG continues to actually have numbers which are either in line or better than expectation for most of the companies. So, from a corporate earnings perspective, we are in a recovery mode. Our sense is, unless there is significant impact of one monsoon and second the war, whereby energy prices go again back to $110 and sustain this immediately for next 6 months, we see earnings actually recovering through this year, which has been our base case right from the beginning, and that is still playing out even in first quarter. Our expectation is that after 2 years of lull in earnings will move back to anywhere between 13 to 15% CAGR, which is the consensus estimates. I think that will largely likely to be met given the way trajectory is. So earnings are moving back. Valuation, of course, the market has not gone anywhere almost for 2 years. So valuation is far more palatable today as compared to where it was 2 years back. Today, large caps are trading at 17 and a half times financial year 28 earnings. Mid caps are trading at roughly 25 times. Small caps are trading at in between these two numbers. So clearly, the earnings is recovering. Valuation relatively are palatable, and that's where we think that there is a case on a bottom-up basis to be far more constructive, despite the returns have been muted for last 2 years. Despite all the challenges, the underlying internals and earnings are clearly telling you to be far more constructive on market as compared to where we were. So earnings valuation context clearly is improving. So that's where we are. From portfolio perspective, we are overweight on financials. Within financials, of course, NBFCs is larger overweight than banks, and then the capital marketplace. We have large overweight on consumer discretionary. Within consumer discretionary, it's quick commerce, it's jewelry companies, it's a SUV company, it's a specific two-wheeler company, which is also a play on EV indirectly. Those are the overweights. Industrials, gradually over last 6 months, we have been actually reducing, so gradually it has gone underweight. Pharma remains a large overweight. Telecom is an overweight. Within consumer discretionary, hotels remains one of the large overweight. And on the underweight side, oil and gas, metals, and FMCG, these are the three sectors, along with a minor underweight on IT. Those are the underweight positions in terms of the portfolio. The last leg, a piece which has been kind of been a bone of contention, has been the FII flows, which I touched upon initially a little bit. I think that was one, again, large negative aspect on market, because while domestics were putting in money, and which continues. Last year, the DII has put in $90 billion in market. This year, we're already crossed roughly, I think, $55 billion YTD. The FIIs sold last year $20 billion. In just in first 6 months, they had sold another $30 billion. In last few weeks, we have seen for the first time green shoots in terms of the FII flows being either positive to neutral, and that's a good sign. And with what is happening on AI side, clearly it looks like at some point in time, the negative technical factor from FIIs on market will recede clearly. And so when you look at valuation earnings context, when you look at the FII directionally where they are, and when you look at our base case in terms of monsoon being okayly distributed, as well as this war not taking oil prices to $110, when I combine all those things, there is every reason to be relatively more constructive on market today than where we were 2 years. Right from September 24, we were largely neutral to negative, predominantly because of our view that the valuation in the context of earnings was very high. But for last 5-6 months, we have turned constructive, and we continue to be constructive on equity from next 18 to 24 months perspective. That's largely for the last month and last quarter from our side. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.